Good morning, everyone. Welcome to the panel on innovations in driving capital to solve social challenges. I'm very excited to introduce Susan Babcock as the moderator for the panel. Susan is a member of the advisory board of the Responsible Investing Group here at Yale SOM. She has worked in social responsible investing and impact investing field for 15 years, first at the Rockefeller & Co. company, and now as independent consultant for family offices and private impact investing clients. At Rockefeller, she was the senior ESG analyst for large cap global public equities and helped launch the Rockefeller Clean Tech Ventures Fund, a private equity venture capital fund of funds. Currently, she focuses primarily on customized impact portfolios for clients who want to invest purposefully across all asset classes. For the past 20 years, Ms. Babcock has also served as a trustee of several environmental nonprofit organizations, including the Open Space Institute, the New York League of Conservation Voters. Before being involved in the responsible investing industry, she worked primarily in the environmental field for such organizations as the Wildlife Conservation International, UNDP, and the Minnesota Department of Natural Resources. She received an AB in history from Bryn Mawr College and a master's in environmental studies from the Yale School of Forestry and Environmental Studies, and a master's in business from Boston University. Please join me in welcoming Susan Babcock.
Thank you very much. And good morning, everyone. It's my pleasure, too, to welcome you all to this panel on innovations in driving capital to solve social challenges. Our particular focus, given the expertise and affiliations of our panelists, will be to explore what's happening in the worlds of microfinance, community investment, and social impact bonds, or SIBs, as I may refer to them from here on out. So these are dynamic sectors of the industry which have experienced rapid growth in the past 10 to 15 years, or in the case of SIBs, just the past 5 years, since the first SIB was launched in the UK just in 2010. There's lots of innovation going on and a fair amount of controversy too, as experts grapple with what investment strategies can best address these very difficult issues of global poverty, financial exclusion, underserved communities, education gaps, social injustice, women's empowerment. We could go on and on. And of course, there's no silver bullet. During this conference, you're hearing from a variety of leaders, heads of social green venture capital funds, SRI mutual funds, state pension funds, ESG research firms, the UN, environmental NGOs, SASB, etc. We need multiple strategies and creative collaborations among all these players to address these issues that we all face and drive real social change. Community investing and microfinance are trying to make a difference on the ground, one small loan at a time, to a family, to a school, to a small business. Since the 1990s, the network of community development financial institutions in the United States has grown to about 880 institutions, including banks, loan funds, credit unions, venture capital funds, with about 65 billion assets being managed. On the microfinance side, since the Grameen Bank was established in 1983, about 10,000 MFIs have been established, although as Songbei will tell us later, maybe 500 of those are investable. Social investment bonds, on the other hand, are trying to mobilize capital in a different way through public-private partnerships with investors, governments, and social service providers in carefully designed pay-for-success programs. So we'll be discussing both international and U.S. investment strategies, and just for context, let's think about where these strategies fit in the broader industry, or for that matter, in an investment portfolio. A major goal for the industry, if I can speak on its behalf, is to think of new ways to mobilize capital for the social good, and concurrently to make sure new types of products are being developed so that different kinds of investors can more easily invest with impact across all asset classes. In the past 5 to 10 years, we've seen a rapid proliferation of products covering a wide spectrum of risk, return, and impact profiles. This panel is all about high social impact, on-the-ground, place-based investments with high social impact, combined generally with lower returns and lower risk, although that's all variable. We're talking about fixed income notes, federally guaranteed CDs, government bonds, direct loans, some equity investments, and more, as we'll discuss. It's an evolving space which our panelists know well. So let me introduce our panelists, and forgive me if I use the term pioneer in each introduction. It just seems to fit. Songbei Lee, Senior Investment Officer from Calvert Foundation, to my immediate right. Calvert, as you probably know, pioneered the development of community investment notes 20 years ago. So both individual and institutional investors could invest in underserved, low-income communities in the U.S. and in microfinance institutions abroad. Songbei himself has extensive experience in India and Central Asia. He served with the Mercy Corps in Kyrgyzstan and the Peace Corps in the Ukraine. To his right is Duncan Goldie-Scott, co-founder of Musoni, the first mobile-only cashless MFI. So Duncan, I know, accidentally fell into the world of African microfinance after a full career in publishing. And since then, he's pioneered the use of mobile payments and technologies in microfinance institutions in East Africa. I noticed he had one of the shortest bios in the program, but actually he has one of the longest lists of founder-chairman affiliations I've ever seen, ranging from social enterprises in Africa to the Microfinance Club of New York. And finally, Casey Littlefield, director at Social Finance US, which is a 501c3 founded in 2011 as a sister organization to the UK Social Finance Ltd, which launched the first social investment bond. The US organization is pioneering the development of social impact bonds in the States and Pay for Success programs. And in 2012, partnered with New York State to launch the first state SIB, which was focused on prison recidivism. As a New Yorker, I was pleased to read that New York City was also the first city in the US to launch a SIB, and we'll see if social finance was involved in that as well. So we have a great combination of expertise on this panel. We're going to start with short introductory presentations by each panelist, then we'll have some discussion. We'll talk about some specific programs and geographies and discuss some of the serious challenges all these groups face in terms of measuring their impacts. Some of the themes we hope to touch upon include the scalability of different investment strategies, the democratization of some impact investing instruments, and the potential for new collaborative models emerging among all sectors. We'll definitely save time at the end for a Q&A with all of you. And so Songbei, we'll start with you. And I might just mention, for those of you who may not know, that community investing is often an entry point for investors thinking of entering the space of sustainable and impact investing. It's high social impact, it's low risk, and there have been numerous campaigns encouraging people to set aside a small allocation in their portfolios for this kind of investment. Okay, Songbei, over to you.
Hi, my name is Songbei Lee from Calvert Foundation. I guess I'll start out by saying that there's a couple things sometimes people get confused about our name, about the Calvert and the foundation. The first part is that we're separate from Calvert Investments, and Calvert Investments actually I'll think John, the CEO, is over here, so I'll be careful what I say. But as was told to me, because I joined Calvert Foundation 3 years ago, the story that I heard was originally when the founders of Calvert Investments, the socially responsible mutual fund company, was founded, they wanted to do basically three things. First was screens, which someone referred to as very 1994, but where the social responsible investing business started. So that's going to be focusing on public equities and public debt, equities and stocks and bonds. And they also want to do shareholder activism. And then third, they wanted to do community investing. And community investing is typically private right now. And so for that piece, it was challenging for Calvert Investments to do that on their own, so they created Calvert Foundation. The second part is, even though they call us a foundation, they didn't give us an endowment. So we don't hold it against them. They gave us something called a community investment note. And this is a fixed income product that we sell to institutions and residents in the U.S. where we raise all the capital that we invest. So we don't have an endowment, and we don't give any grants. So that's something we have to often explain. And thanks, Susan, she suggested I get some slides. I actually grew up with overheads and transparencies. So really, I just took some screenshots from our website. But let me see. So the first one, this is just a simple screen showing how it works. So basically, any one of you can buy a community investment note for as little as $20. We aggregate all that capital together and we lend it to our partners. And these are going to be nonprofits and for-profits, and that's something we can discuss more later about the differences between those type of borrowers. And the type of organizations we lend to are going to be using that money in the U.S. is going to be to finance affordable housing projects. It can be to finance the purchase of a charter school. And internationally, a lot of it is microfinance and also some fair trade. So you, the investors, will get to share in the social returns, also get your money repaid, plus some interest. And hopefully, you will reinvest that money, and then we can recycle it. So the difference between that and a grant is that you just give the grant once, whereas if you invest the money in Calvert Foundation, this is money that, as was discussed before, a different kind of multiplier effect because we can continue to use that money in the future. So this is just a slide showing the different ways that we sell our community investment notes, which I think for us is fairly important. So when we started in 1995, we only had one route called the direct, and that just meant that you would actually just write us a check and send it to us. Starting in 2005, a really big innovation, and one that Calvert Foundation is well known for, is in addition to having the community investment note, we registered it. So that means now we wanted to make it more accessible for you, so you could actually buy the community investment note through a brokerage account. And so something I want to mention is that our overall mission is to channel capital to low-income communities. But the interesting thing about impact investing, which typically is around private equity and private debt, is that it's only accessible to accredited investors. And so that we're talking about high net worth individuals. So we wanted to be able to make a product that's easily accessible as far as just using it through your brokerage account, and also with much smaller minimums. So we also, in 2007, we made our community investment note available through an online platform. So you can invest for as little as $20. So this is the same slide, but just pointing out some, actually the type of investors where we raise capital. So one thing I'll mention is our total loan balance right now is about $200 million. This shows over time the cumulative amount that we've raised, which reached $1 billion in 2014. So when we started out, we were raising money from a lot of like-minded investors. So we're talking about socially responsible mutual fund companies. We're talking about charitable foundations or faith-based organizations. And after we were able to develop a track record, we started raising capital from individuals and institutions. One thing I want to point out is that we follow the 80-20 rule, where 80% of our capital comes from institutions, but they only represent 20% of our investors. So that other 80% of our investors, even though they might not form the bulk of our capital, they're who we really focus on. So a broad mission of Calvert Foundation is to democratize impact investing, and this is all through our community investment note to really make this type of investing where you're making decisions like investing based on your values and making it accessible for everyone. And so this is the same time period, but this is actually the money out. So the first two slides were on the money in, raising money from our investors. And that reached $1 billion cumulatively. And you'll notice here, if you look on the website, because the print's kind of small, this is only reaching $800 million. Just to point out, that's because the money that we raise typically has shorter tenors than the money that we lend. And this goes to the point that asset liability management is really important, and it's something that we always struggle with and we're focused on. So basically, the sectors that we lend to, the largest one is CDFIs. So, and the second largest is microfinance. So I think most people have heard of microfinance. So these are loans to microfinance institutions in places like Kyrgyzstan, where actually I used to work, where the loan size would be as low as $300 in a group lending model, which was really pioneered by Muhammad Yunus in Bangladesh. But also, CDFIs are a very similar type of organization. So Community Development Financial Institution is a designated type of entity by the Department of Treasury, and that was created in the mid-1990s. So Calvert Foundation really specializes in lending to other intermediaries that then on-lend into the communities where they work. CDFIs also have a strong affordable housing component. About 60% of the business CDFIs do is financing affordable housing projects. And they also do lending, facilities lending to things like health clinics and charter schools. The balance of our portfolio is after CDFIs and microfinance, is affordable housing directly to affordable housing developers and fair trade. So this last slide is also, if you go to our website, calvertfoundation.org, you can see all these graphs, and they're actually interactive, and also a map of all of our partners around the world. So a couple of things I just want to mention in closing, and happy to answer questions specifically about them later, is I know this is a low carbon conference. So one of the things we do have in our portfolio are cook stove companies. And these cook stove companies are really interesting because they benefit from generating carbon credits, the reduction of carbon, and that they're able to sell into the market to help fund their business model. That has been a very challenging business, but it's something that we hope that will have more opportunity in the future. Second, I know we're talking a lot about clean energy. We do also have a growing clean energy portfolio. And it was interesting that Ira mentioned DBL's investment in Tanzania, that we are also, we're not an equity VC investor, but we have just recently approved a loan to that same borrower. And so that is a borrower in Tanzania that installs solar home systems. And we think that is really, really an exciting and growing field. And another thing that was mentioned was agriculture. And this is another area that we're looking at, and really the combination of clean energy and agriculture. And then the last point I just wanted to bring up was the question about equity. And so we are a nonprofit. So one of the challenges we have is raising equity, which we can't do. So this is something definitely also we see in our borrowers. Typically in the US, our borrowers are nonprofit, and our borrowers internationally are for-profit. So I think each presents its own challenge between raising capital or making sure they don't have mission drift. For Calvert Foundation, it's been interesting. We've been exploring different ways to raise equity on our balance sheet. And so far, we just have some short-term solutions that kind of involve a lot of structuring and the creation of new SPVs. And happy to talk about that more as well if people are interested. Thanks.
Great. Thank you, Sangbei. Duncan, moving from the whole map to Africa in particular.
Right. So I've invested personally in about 19 companies, mostly in Africa. And these are some of the logos from the companies, not all of them. And about half of these are companies that I've actually started myself. So I'll have an idea for a company, recruit a management team, seed fund them, and then push them out into the market. And so obviously I can't talk about all of them, so I'll talk about 3 or 4 of these companies just to explain what we do. So you probably know the science fiction writer William Gibson, and when asked how he crafts the plot for his novels, he says he looks around to find something in the world happening today, and then it exaggerates it to try to predict the future. So the future is already here, it's just unevenly distributed. And the reason I like this is I've really focused on the impact of the mobile phone in emerging markets. This is a photograph taken in Mandalay in Myanmar in August last year. And the government reduced the tax on SIM cards for mobile phones. And so the cost of a SIM card fell from $1,500 to $1.50. And this is what happened. This is the queue outside the mobile phone shop. And I was just reading yesterday, actually, in Myanmar now, 50% of the population have mobile phones. 80% of those mobile phones are smartphones. It's a higher penetration than in the US. And I would be pretty certain that this has had is a major factor in the return to democracy now. People are connected and better informed. In Kenya in 2007, Safaricom launched a mobile payment service called M-Pesa. And around the country, there are about 100,000 of these M-Pesa agents. 80% of the population have an M-Pesa account. And so you go into these agents, you hand over cash, you get the money on your mobile, and then you can send that money to any other phone in the country. You can pay your bills, you can whatever. I mean, when I'm in Kenya, I don't carry cash or credit cards. I just carry my mobile phone because I can use it for every transaction. And about 45% of Kenyan GDP now goes through the M-Pesa system. People get their salaries paid on the mobile, and so anyway. So because of M-Pesa, I started this microfinance bank called Musoni, and it's very traditional microfinance, but except we don't handle cash. We send out all the loans via M-Pesa, and the clients repay the loans via M-Pesa. And that means when we have group meetings, instead of spending, with 30 people, instead of wasting time counting out the cash and then going to the bank and marking the logbooks, we have everyone repays before the meeting. The loan officer has the data on his tablet, and it's just all automated. And it means I can open a branch for the cost of a desk and an office, $5,000, whereas a traditional microfinance bank would need a strong room, security cameras, cash handling, and it'll cost $100,000. So it's very cost effective. So although we save money in not handling cash, our loan officers still have to go and visit the clients and look at the business and assess the credit risk, which is a major part of the cost of microfinance. So we've started a company to create credit scores using people's mobile phone data. So everyone in Kenya has had a mobile phone for 4 or 5 years or longer. And if I can access the history of their mobile transactions, I can tell everything about them, age, sex, income levels, and the credit risk. So for about 1/3 of the borrowers who come to Musoni now, with their permission, I access their phone records, I can create a credit score, and if they're in the low-risk bucket, I can just send out the loan without any more due diligence. So it's a massive cost saving in microfinance. And I'll come back to the use of data in microfinance a bit later. Another problem in Kenya is that you have huge African diaspora communities all over. Zimbabweans in South Africa, Somalians in Kenya, and they're always sending money home, and then Kenyans overseas sending money to Kenya. And sending money to Africa is more expensive than anywhere in the world. Western Union is typically 12%, and the internal remittance corridors in Africa are even more expensive. So we set up a bridge between Bitcoin and M-Pesa. And so anyone with Bitcoin can now send money to anyone in Kenya, essentially for free. We have no minimum transaction fee, and we take a 3% spread on the foreign exchange. BitPesa is now live in Uganda, Kenya, Tanzania, and Nigeria. And for 2 years, we've had consistent double-digit growth month on month. It's a hugely interesting market. And yet again, Africa can be the showcase for Bitcoin. There is a real use case in Africa, much more so than there is here. And finally, one of the problems in microfinance is it's very hard. It's just getting the data on the clients again. And so we've been looking at how we can gather more data on farmers to extend microfinance loan to farmers. So FarmDrive is a very new company. The two founders have built a tech platform to enable farmers to use their mobiles to send data about their yield and so forth. We validate that data with from other parts of the supply chain, from the co-ops and so forth. We've now got soil testing equipment linked to the mobile network, so we can plug a soil tester at the farm and send the data over the network directly into FarmDrive, so we know which crop the farmer should be planting. And then we use machine learning for satellite data to look at Google Earth images to do things like analyze rooftops to estimate the income level of a farm. We can map out the boundaries of the farm. We use all free infrared data on rainfall, sunshine, temperature, humidity, so we know which crop they should be planting on the 1st of May. We know the rainfall, so we can predict the yield of that farmer, okay, before the farmer can. And actually, we can build insurance into that as well. So if we can tell if the crop is failing because of the rainfall or whatever. So we can arrange a payout to the farmer so he can afford to buy the seeds to start another crop cycle. This is the use of big data in lending in Africa, I think, is just so much fun, and it can have huge impact. And finally, and then we talk a lot about the unbanked, and I'll explain this chart. Does anyone here work for McKinsey? Okay, good. This was a this is a chart produced by McKinsey of the unbanked in the world, and you'll see that they estimate that in North America only 8% are unbanked. I mean, I think that's a massive underestimate of the cash economy here. And they have Kenya down at 80% unbanked, which I think is a complete misunderstanding of the nature of financial services in Africa, because everyone in Kenya has an M-Pesa account, which is like a checking account. It's better than a checking account, because I can send money person to person. Everyone with an M-Pesa account has access to M-Shwari account, which is a savings account that pays interest. And actually, Kenyans are more financially included than North Americans. But the McKinsey consultant sitting in New York is trapped in thinking about traditional bank accounts, credit cards, PayPal, and it's just the wrong way to think about it. But what is interesting about this chart is that the entire grey area there is the world of online commerce. iTunes, Amazon, Netflix, HBO, everything you pay for online, you have to have a traditional bank account or a traditional credit card or a PayPal account. And so sitting in Kenya, there is no legitimate way to access the world of online commerce. So every movie you buy in Kenya is an illegal download or an illegal DVD. So we're just starting another company to do a reverse of BitPesa. We're doing M-Pesa to Bitcoin to video content to try to connect the world of online commerce and the people in Kenya. And I'll leave it there.
Thank you. Casey, moving back to the U.S. and to the new kid on the block, investment block.
Yeah, that's a fun act to follow. 80% of sub-Saharan Africa, SIPs. So I'm Casey Littlefield. I'm a director at Social Finance. Susan did a terrific job explaining who social finance is. So we're a 501c3, a nonprofit organization that structures pay for success and social impact bond projects. I'll use those terms sort of interchangeably. This is the fun of working in a new market, which these guys know very well. The terms are up for grabs, and different stakeholders and different folks use them interchangeably or have an affinity for one or the other.
This is still true in the responsible investing industry
I mean, it's
in
really
general.
one of the challenges about spreading the market is that if you can't get agreement on what these terms actually mean, it makes it really difficult to get broad buy-in. But I will talk about Pay for Success as a broad project and outcomes-based contract between a jurisdiction and another entity that's focused on driving dollars towards prevention. And SIBs we think of as the financial instrument that's actually doing that. So the contract between investors and the SPV. So that's how we think about it, but again, you really use them interchangeably right now. So what is this? What is Pay for Success? What are SIBs? This is an opportunity, an innovative funding tool to drive dollars to programs that work. So these are public-private partnerships that are set up based on outcomes-based contracts that are mutually agreed on by all parties before the contract is executed, such that investors fund nonprofit service providers who enter into these contracts. If outcomes are achieved, then the government entity repays the investors. If outcomes aren't achieved, then the investors aren't repaid and government doesn't pay for what doesn't work. So where did this come from? What's the idea? Why are we doing this? Our friends over in the UK, and this is Ronnie Cohen and David Blood, who that name will resonate for some of my environmentally focused friends, basically saw two problems. The first was that we don't really know what social service programs work, and that governments have a tendency to look at budgets retrospectively and simply change based on a predetermined metric, outcome, percentage, how much we're allocating to those budgets year on year. The second piece they saw was that there's an opportunity to actually value in a quantitative way what social value means or what community value means. And as the world changes, it is no longer okay to only look at economic returns and think about what that actually means. And I say not okay, not in a value judgment way, but in a way that there is an expectation both from investors through the generational wealth transfer, but also there's an arbitrage opportunity to value or quantify what the social value or community value is that's added by an organization, and finding a way to value the whole opportunity in a more robust way. So looking at those two pieces, we set up this essentially triangle. So we have government at the top, we have nonprofit service providers, and we have investors. Social finance sits right in the middle of that triangle. And what we do is try to translate effectively all day, every day, the language between all three stakeholders. We set up these projects with an SPV, so really on the kind of nitty-gritty side, what does it actually look like? There's an SPV at the middle that holds a contract with the government. That's the performance-based public-private partnership. There's separate contracts with investors, financial documents. These can actually be loan offerings or private placements. We structure both of those. And then on the back side, there's a contract between the SPV and the nonprofit service provider. So all of that occurs, we set that up, we spend 5 to 7 years just availing services to really vulnerable populations, and then we measure outcomes along the way. Each of these projects look really different. We have seen the initial test case was around recidivism. That makes a lot of sense to people. It's something they can wrap their heads around. So if someone leaves prison, state prison, county jail, whatever level of incarceration it may be, there's a high likelihood that that person will go back to either the prison or the jail. That's hugely costly to the government. Paying for bed days is something that could be averted through what we've seen to be tested strategies in workforce development and training. So can we connect recently released high-risk prisoners to really strong cognitive behavioral therapy, really strong work training where we get vocational skills, potentially even certification and licensure, and then long-term support and mentorship by contact with the mentor who's providing some of the job training, and prevent that person from going back to jail, setting them up for long-term success, but also avoiding some of the heavy costs associated with housing them in the long run. That was the first test case. We've now seen really a proliferation of different strategies. We're seeing some tiptoes into pre-K. There's been a lot of work done on the value of pre-kindergarten, and if you can get someone really strong pre-K, can you actually help them not only to have better achievement scores through school, but also lower incidence of interaction with the criminal justice system, lower utilization of healthcare services, and lower utilization of special education services. We've seen a lot of work in prenatal care and maternal health. There will be, I think, probably an explosion of projects in the next 2 years focused on maternal health for similar reasons. Seen some work done in diabetes and asthma prevention. And then we've also seen some work in child welfare that we'll see. So all of that's to say is that we're learning as we go. It's a pretty exciting opportunity to get to work with really diverse stakeholders and connect them in new ways. And it's been a fun ride for us. And I think learning from the folks like Calvert who've gone before us is the only way that we can actually build this market as we go.
Thank you. Casey, maybe I'll follow up with you first, actually. Just the opposite of what I told you guys. Because there was an article in the New York Times last week. I don't know if any of you saw it.
Yeah.
I know you saw it.
A lot.
So it was called "Did Goldman Make the Grade?" And it was about a SIB program started by Goldman and the state of Utah.
Yep.
And it questioned whether they had used the proper metrics in determining the success of the preschool programs and, in turn, the payment that the state would give to Goldman. Do you want to comment on that particular case? I don't know if that was one of yours or.
Absolutely. So, and this is a little bit different than some of the traditional asset-backed community investments that you might have seen in other cases. So when you're working in social services, how do you know whether or not these programs work? You set up rigorous evaluation. That means randomized control trial, that means quasi-experimental design strategies, of which there are lots of flavors, or it means at least use of historical data to check whether or not when someone comes into the program, there's a difference from when they leave. So the Utah project was not our project, so I don't have all of the details. I can't say with complete authority whether or not the project was set up rightly or wrongly. What I can say is that Pay for Success is about driving dollars towards prevention, and effectively 600 kids got pre-K that wouldn't have gotten this program before. In terms of the metrics and the evaluation, the way that we structure these projects, we set up a scenario where governments are interacting with service providers and looking at data to set these outcomes. So from my understanding of the project, the Granite State School District sat down not with Goldman, but actually with the service providers and said, what does your data tell us about what we can expect? And then they set up a series of metrics around what the government was willing to pay to operate in this cash-strapped environment, to have access to working capital, to fund the slots for pre-K that didn't exist before. So from a metrics perspective, the idea is that a government has to gut check, and the role and responsibility of the intermediary is to have that unbiased, impartial place at the table to use the data to help you pick what those metrics are.
So all of these deals can be very complicated.
Yep.
And metrics are key.
Absolutely.
As they are in all parts of social impact investing. Well, I'm conscious of the time because I know we need to wrap up soon. I had some other questions. We were going to talk a little bit about India, Songbay, and how it's kind of a microcosm for controversies and challenges in the microfinance industry, and maybe touch briefly on how Calvert has left after the controversies 7 years ago in Andhra Pradesh and then has gone back in, and you are both, one question is nonprofit or for-profit microfinance organizations better to work with or more effective? And so this is really a question for both you in India and Duncan in Africa. Which organizations work best in this sphere?
Sure. So India, the Indian Diaspora Initiative is something that we launched earlier this year, and it's really targeted to raising capital from Indian diaspora in the U.S. and to channel it to organizations in India. So I think there's a couple parts of that question. One is that microfinance overall, and really there was crises in different countries, but the biggest one happened in India in 2009, Andhra Pradesh, when some microfinance companies, institutions were accused of being too aggressive in lending the money and causing over-indebtedness, and also too aggressive in trying to collect that money in the end. So that really caused a collapse of the microfinance sector in India and also had implications globally. And then I think the second thing about India is that it's a very difficult, it's a huge opportunity, but it's very challenging to be an international investor there. And one of the reasons is they don't want, they really want to limit fast money, people coming in, investing and then leaving at the sign of trouble. So they set up a lot of hurdles so that once you go through all those hurdles, you really stay committed. So I think now, today, the opportunity, and it just was so large, and the microfinance industry, as you mentioned, they have rebounded, and there are things now, there's new regulations the government has been focused on globally. There's initiatives like the SMART campaign where MFIs will sign up to make sure that they're being transparent and responsible lenders. And the last piece about, I think there's also a good example of a for-profit or nonprofit MFI. We're looking at one of each right now in India. And the for-profit is very large microfinance institution, very professional management, people who have all had extensive experience. They just received a small banking license. So in one sense, that this is the evolution of microfinance from a USAID grant-funded nonprofit to transforming to a for-profit and now getting a banking license. So along the way, bringing their clients really fully into the financial services sector. And so on the other hand, the other MFI we're looking at is still a nonprofit. So they are not able to grow as much because they're not profitable. Because they're not as profitable, and they can't raise equity. but they work in the harder to reach communities in India, and they are much more, you'd say, in the field and on the ground. So we really do like both, but they definitely serve different purposes. And I think the maturation of the microfinance market is that you understand that there's different roles for different types of MFIs.
Duncan, is the SMART campaign used in African by MFIs in Africa, or do you pay attention to that? Or
Not that I'm aware of, but the problems in Kenya are that the traditional microfinance model is very expensive to operate. So the only way you can do that cost effectively is in urban and peri-urban areas. And we were discussing this earlier. Every traditional MFI in Kenya operates in the same markets. So you'll go to a market town like Kitengela and you'll find 25 MFIs, all trying to lend to the same clients. And when you meet a new client, you ask them to declare, do you have any other loans? And they will always say no, and they're always lying. And the problem, bad debts arise from over-indebtedness. So the problem is, so we're doing much more information sharing now between the MFIs, and there are credit reference bureaus. But I think that particular model of microfinance is very limited, and it only reaches probably 10-15% of the population in Kenya that would need to borrow money, that needs access to credit, but traditional microfinance can't reach them. Now, the market is changing very, very rapidly, partly through the things we're doing, using data to automate the credit scoring for new. But there are dozens of new companies coming into the market, for example, doing peer-to-peer lending over the mobile. So you may be anywhere in the country, you give us access to the mobile data, you score that, and then somebody else will lend you money on the network. So it's like Lending Club or Prospero here. There's one just started in Kenya called Pesa Zetu, where we're actually doing the credit scoring for them. But there are Matt Flannery, who started Kiva. He's started a company called Branch, doing the same in Kenya. And a Californian company, Inventure, they're doing something very similar. So I think the market is changing very rapidly into the use of data and mobile.
So this is all incredibly exciting to me. So much innovation in all of these spaces. And I have to say, in the responsible investing industry in general, for 10 years, I think I've been saying we're at a tipping point. But now I really think we're all at a tipping point. And I'm wondering if you all feel quite optimistic about the chances for success in the various strategies you're involved in.
Yeah.
Yes.
Go ahead.
Well, I guess the answer has to be yes, because otherwise these poor people would be very depressed about what careers they should choose.
One thing, a comment on that is that for us, like one thing we've seen is it's a huge opportunity and a challenge is that the impact investing space has matured. And as it's matured, we've seen that people it makes more sense to take more specialized roles instead of trying to do everything. So we try to do everything from raising the capital to deploying the capital across all different sectors. So things like CDFIs and microfinance, they're a core part of our portfolio, and they'll remain that way. But going forward, we'll work with partners who really focus on those areas and can bring they have people on the ground, they really understand that space and leverage their ability to deploy that capital. And for Calvert Foundation, what we really focus on now is on the capital raising side. And so for us, I think that is a really big opportunity. We talk a lot about building the plumbing to really reach a larger audience who are interested in supporting this space, and then we'll help channel that capital into the field.
Shall we open it up to questions from the audience? Do we have some questions? Yes.
Yes. So I've been to a number of talks about microfinance, and I think it's a great premise, a great practice, et cetera. But what I kind of find frustrating is that it seems that the goal is to make folks who are unbanked consumers of banks, but never investors and such. So let's get your credit up so you can become a consumer online, or let's allow you to do more mobile transactions. The conversation seems to always fall short of how can we get folks to break the cycle of poverty. And I look at my own example is that, it's not just through having a bank, it's not just having a savings account, it's through investments. Maybe your parents have a pension, or maybe you have an insurance claim, or maybe you have stocks and
Can I? I mean, the thing to remember about microfinance is that peddling expensive debt to the poor is not a solution to poverty, which is what a lot of microfinance has been. The key is to find people who need working capital to grow their businesses. Yeah? I mean, take the smallholder farmers. If you have no data, they have no access to credit, so they can't buy the good seeds and they can't buy the fertilizer and so forth. So you need to be very directed. You need to know who you're helping and who you're not. It's not a panacea.
Yeah, I would just add that I think as part of it was a marketing problem that microfinance, I think, set up for themselves by saying they were pulling people out of poverty as a way to generate, raise capital. But I think what they were doing was providing financial services to people who previously did not have them. So that's one part. The other part, what you're saying is true, that building assets is much more effective. If you have a credit card today, that's going to help you it's much more convenient, but it's not going to help you improve your financial situation. So that's why microfinance institutions getting bank licenses are considered important, because that will allow them to take deposits and help people generate assets. And the last piece is along that same line. They're actually pulling them more into the formal financial sector, and the more regulated you get, the less flexibility you have to do other things. So what the interesting thing is happening is they're becoming more like formal, traditional financial institutions for these traditionally unbanked communities, but they're not providing the type of services you might be describing as actually services to actually really direct services to help them get out of poverty, like health, or even just health services or education services. And those typically now are still going to have to be done probably by some sort of subsidized direct service nonprofit model.
Okay. Yes, in the back.
Definitely SIBS. No, I can take a little bit of a stab at these guys. You are certainly looking at private sector work more than we are, but I will say that there was definitely a philosophical debate in the beginning around SIBS that still rages around whether this is using philanthropy better or this is getting private dollars into the system. We believe that having some of the market discipline associated with private capital is really important, because there are billions of dollars spent every year on social services and via philanthropy that aren't solving generational poverty issues or intractable social problems. So there is something around this idea of getting private dollars in where there are strings attached that feels important to us and adds some pressure to this performance-based contract. The other piece that I will add is around specifically working with other organizations that are learning from experiences in the private sector. And it's not a bad thing to be blending those two worlds, and we can be learning from each other as we go. Yes.
Yes, you invest in form of loans. What has been the performance of your portfolio? And if things do go bad, how do you fix it? Do you take an active role in managing it and applying the experience on other funds? Because presumably a lot of these investments will create challenges.
Mm-hmm. Yeah, I think we have a 98% repayment rate. I think we're very proud of that. No investor has ever lost money. So as far as we also have a lot of credit enhancements on our portfolio that protect the investors. I think that our repayment rate is reflective, I think, what people were surprised about in microfinance in general, to use an example. Just because people might be poor, that doesn't mean they're a bad credit risk. I think a lot of it at that time goes back to the point Duncan was saying, is that you just need to understand the market, and today we're doing that through a lot more data collection, but even in cases without data. As far as when things go bad, definitely this goes back to what a few people have already mentioned, the type of borrower or the type of lender you are. And we try to stick with our borrowers and work with them as much as possible. And so, typically, just in one example, if a borrower is not able to repay, then, we'll form a lenders group. And I guess the easy way to describe it, it's going to be the same way a commercial bank would address it, except I think that we always, like to establish relationships. Some of our first loan in 1995 to an affordable housing developer is still in our portfolio. A lot of our other loans, once we give a loan, we'll increase that loan and renew that over time. So it's something that, the best thing to do, obviously, is to be ahead of that and stay in constant contact so you know if there are problems, but we always look to work with them as close as possible. But in some cases, of course, there have been times where we have not been repaid.
Okay, we have time for a couple more questions. There.
This is for Casey, thanks. Can you talk a little bit more about the design of performance of metrics and indices and KPIs and how to contextualize them better? And I don't want to pick too much on the Rikers Island case, but I spent a lot of time over the summer actually digging into what sort of happened there.
Yeah.
And you don't necessarily have to address that, but I'm trained as a social scientist and urban designer actually, and I'm always just very interested in how social systems and well, let's just say the tendency to standardize performance metrics from one case to another, how that's done often. And I'm just curious, in terms of actually contextualizing something where you have very, very complex demographic issues that vary, say, from Peterborough prison in the UK, where pioneered to totally different demographics, and how can we improve this?
Yep. What's really, just the
last part.
Yeah.
Just that there's also a tendency for revisionism with consultants, which requires third-party auditor who understands it to see how it can, in fact, is gamed all the time.
Yeah, no, so you've hit on this has been a fascinating debate quite literally in the last 2 weeks, because we had Rikers Island news over the summer, again, not a social finance project, and I can tell you a little bit about what I know, but where the outcomes metrics, so for those who don't know, it was a recidivism project focused on a flavor of cognitive behavioral therapy for high risk youth. So it was, I believe, kids between the age of 18 to 24, there were Rikers. And then we had the Utah project come out. So Rikers Island didn't meet threshold, so there was some impact on recidivism, but it wasn't as big as was established, and so investors weren't repaid. And the project was not renewed for its next cohort. Utah, great results, focused on reducing SPED utilization for kids in the Granite City School District. They expected, of the 100 kids who scored 2 standard deviations below the norm on the pre-test, those kids, only 1 out of the 100 that they thought would go to SPED went to SPED. So the question that's being raised is, where did those metrics come from, and why are we extrapolating from existing evidence, existing RCTs that are pretty contextually specific to help predict what those outcomes will be in other contexts? And it's a really important question, and it's one that hits on a lot of the struggles that we have of taking what is theoretical and what happens in the academic world and what we can apply in a pragmatic way. So when we look for a SIB, we're looking for a strong evidence-based intervention, which typically would mean, does it have an RCT? We would be foolish to believe that an RCT, and there's been a lot written on this quite literally in the last week, an RCT is completely able to be replicated in a new context. What it does mean is that in one context, we know that this program worked. And so finding what the secret sauce is how can we get down to the building blocks of what that was and replicate that over time. The nonprofit space has traditionally been horrible, for lack of a better word, at scaling. It's really hard to do. It's really hard to do for big organizations, big for-profit organizations that have a very clear client and are operating to a bottom line. So what we try to do is get down to those building blocks, which are those outcomes. And so what we would start for is looking at the target population, a very specific population, 18 to 24-year-old males on Rikers Island, and try to figure out specifically what the inflection points are that will be changes to behavior that will indicate long-term outcomes over time that are successful. The RCT is the starting point. The quasi-experimental design is the starting point. We can't guarantee that these projects will be successful over time. And that's why what's troublesome in some ways is that these projects are risky enough. We should be looking at double-digit venture capital size returns, and we just can't in the impact investing world. But I think the ability to shift some of the government spend or investor capital to looking at preventative interventions is the first step, and really wrap around to some of the CDFI low-income housing work that started in the 90s or really blew up in the 90s to try to tackle some of the entrenched issues of generational poverty. And that if you're looking at a paradigm that is effectively, we don't know enough and these projects are so risky that we're going to do nothing, or we're going to do our best and we're going to use credit enhancements and lower returns and folks who are willing to try to put their dollars to work, and it may not work out, that we would shift to the side of the continuum that is around taking some of the risk and trying to tackle these problems and coming out with some indication that is data-driven around whether or not we were successful.
Do we have time for one more? One more question. Did you want to say
I
something?
just want to say there's a really good book about why it's so hard to stay out of jail, and it's called On the Run, Life as a Fugitive in an American City by Alice Goffman. It's fascinating.
Thank you. And who had the question? Did you?
Structuring, yeah.
Do they agree upon them?
Yeah.
Does that create conflicts?
Yeah.
Because they're so tied to
Yeah. So it depends on the type of deal. And one of the cool things about this, and I think we're learning from Calvert on the way that you start with one and you kind of tweak on the edges and about the different structuring. So if this is a private placement where we're going and we're placing this on a high net worth platform, the terms are effectively baked before the retail investor actually has access to them. So they would just agree to them. That does not mean that the institution that is placing the deal hasn't done a thorough due diligence process to make sure that they completely understand the risks and are a part of that conversation. Some of those financial institutions have been interested in finding more projects for their clients to invest in, and in that way they would be a part of the outcomes and metrics conversation because they were sponsoring some sort of project where we're looking at, is this a good idea for maybe a SIP or a good fit for an issue area for a SIP? On the flip side, if this is a loan offering, there's been a whole spectrum in Massachusetts. Again, not our project, but Goldman was at the table very early and had a part all the way through the conversation. On a project I'm working with in Connecticut, we ask for feedback along the way, from financial institutions, but we're very focused on making sure that we're playing that impartial role, and so there are tweaks on the edges. We wouldn't want to set up a project that was overly skewed towards one stakeholder.
Okay, I'm afraid we have to wrap it up. You're welcome to come talk to our panelists afterward, and I'd like to say a special thank you to all of you for sharing your expertise with us, and more importantly, for doing the work that you do. And I'd like to thank all of you for your interest in this panel.